We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
You got to have the why, and we know our why. So
you don't need to reinvent the wheel. Yep. Millions and millions of people have done this already. You can get help, you can get a roadmap, you can save a lot of time, money, and frustration. Welcome to the Value Add Podcast with K&K.
Hey everybody, Value Add with K&K. Crystal and Kenny here. Just want to say thank you so much for the support, for listening, the comments, everything. Keep it up. We'll keep going as long as we can.
And if you like what you're listening to, like what you're watching, tell your friends about it, leave us a review, maybe even give us 5 stars.
We love those.
That's how we can grow and continue to bring you guys value and spread the word.
Thanks, guys.
All right. Welcome back, everybody, to another episode of the Value Add Podcast with K&K. Today, we have 2 rock stars with us from Private Business Capital. That's a division of CalPrivate Bank. We have Joe Taormino, also kind of our neighbor, and Steve Pollett.
Kind of our neighbor? He's
our
neighbor.
He's like adjacent. I mean,
it's like kind of. That's a neighbor.
He's a neighbor. He's not next door, but, you know.
He's close enough.
Yeah.
Across the cul-de-sac.
Yes.
Yeah. I mean, if I can hit his house with a rock, it's a neighbor.
I couldn't hit his house with a rock. But yeah, you could.
Guys, thanks for coming in.
Yeah.
Thanks for having us.
Pleasure.
So whoever's been in the business longer, I don't know, it's not Joe. I could actually.
I have a lot of gray hair, but
I do.
Not as much as
you
his.
do.
Yeah.
You're gonna catch up though soon.
Oh, it's going. It's going. I'm causing it.
I'm sure. Steve, you kind of give us your background and how you've landed here.
In the business, in my lovely SBA business?
Yeah, or just banking in general, or yeah.
Banking in general. I worked at a law firm, going to law school, and our client was the CDC Small Business Finance. They're the ones that fund the SBA portion of the 504s. I was closing loans for them and decided that rather than continue with law school, it would be better to work for that client because it was more fun, helping small businesses. And that was about 30 years ago.
Wow.
So I went from closing loans, moved into sales, and that's where I've been ever since. So I've worked at a couple of different banks, mostly smaller banks throughout my career.
And you and Joe have kind of been together through a couple different banks as well, right?
Yep. Two that we count.
You were at Plaza, right?
Yes.
Okay.
Yeah.
Okay.
There's one in the middle we don't count.
Yeah.
We won't talk about it then.
Let's not. Legally, I don't think we can.
There is that.
Joe, how long you been doing this?
About 5 years.
Okay.
Yeah. Prior to this, I was in a totally different industry, dental consulting.
Ah.
Wow.
Got tired of being on a plane about 5 days a week, and I totally stumbled into SBA by random chance.
How did you stumble? I don't even know if I know.
I want to hear his side.
Yeah. Oh, here we go.
Well, just networking, and through a friend of a friend, found myself at a lunch with a broker, like Crystal,
yeah.
And he said, "This is a great business to be in. You could work for me and make nothing and drive up to Orange County all the time, or you could start at a bank," which is how I started. And I know someone in San Diego that could do that for you. And he introduced me to my first manager, Todd Masses.
Todd.
Yeah. And by the time I drove back from San Clemente to Carlsbad, he's had me on a 3-way conversation with Todd, and 20 minutes later, I was at Todd's house in Del Mar. A month later, I was hired. Plaza Bank.
And then you're there?
And Steve was there. Yeah.
And then here comes walking in this guy.
Yep. Steve was not there. He was never there, except for
I worked there.
Once a quarter. Yeah, he worked there.
I worked there.
Yeah.
The home office is always your favorite place, right?
Yeah.
Steve inherited me about 6 to 8 months into my SBA career.
Okay.
And then we've been together since then.
And so, Steve, your title at PB Capital is Production Manager, right?
Correct.
Okay, cool. And then, Joe, you're like a business banker?
I am a business development officer.
Aha.
I would not call myself a banker.
Okay.
No.
We do loans.
You guys are
Just
not
loans.
bankers.
Okay, so
No
you guys
banking.
don't want to like bank people at all.
Our bank does.
Okay.
Yes.
But
You want to lend money.
I want to lend money, and if they want to bank with us, we pass them along to a banker.
Cool.
Yeah.
But it's not a requirement?
No.
Okay. Cool. Because like a lot of business banks do require that.
Right. We're the transactional arm of CalPrivate Bank. So it's a different, it's set up that way. That's why we're PB Capital. We're the transactional arm. We don't require a deposit relationship. If you want to, that's great. It's a good bank, but it's not our thing.
Well, that's good to know because I think a lot of people out there are going to get loans for their businesses or the property that they're buying for their business. And every bank literally wants their relationship and it really just requires it as a condition of getting a loan with them. So it's nice for them not to have to move that relationship because it's never easy moving your banking. That's always a conversation that we have when you're going to get a loan.
Absolutely.
So that's a good.
It makes it better though. I mean, it makes it easier for us to do our job if they want to, and we will always welcome it.
Yeah. But it's nice that it's not a must.
Him?
It's not a condition.
Oh, Steve.
I got it.
Okay. I was like, Steve, so why did you pick, did you just pick SBA or you just fell into it? You just stayed there. You never ventured?
Just fell into it.
Okay.
I mean, it's my third career. I started in the grocery industry. I did that for about 12 years, got into management, didn't like it, told my general manager some things I shouldn't have said, so I got demoted back.
That's awesome.
So I'm back stacking cans at midnight. So
Okay.
I figured that probably was time to move on to a new career. So started going to law school, was working as a paralegal at a local firm.
Oh, wow.
It was fun. It was a great job. I liked the firm. I liked the idea of the business, but ultimately being a lawyer requires you to do things you don't necessarily want to do. And so I started looking for a client that I wanted to work with, and this was a good client.
I feel like nobody ever says, I want to be a banker or I want to be in real estate when I grow up. It's
Can you imagine?
something you fall into.
Kramer from Seinfeld said he wanted to be a banker. Just throwing that out there.
Yeah.
You guys want to know.
Of course, Kenny would remember that.
Of course
he knows
I did.
every
Yeah.
episode of
Yeah.
Seinfeld.
What do you think's changed with, like you've been in this 30 years, which is awesome because it's such a different perspective. I mean, we haven't even we've been in
Half the time.
that. Yeah.
Like 16 years.
But we're commercial, residential, but you're not even doing like what he does. You're more business lending. What's changed, do you think? Like what's been one of the biggest changes?
Well, in that time frame, I mean, the biggest change probably is the success of the 504 program is a lot different than it used to be. The SBA has been more attentive to what the clients need. They've raised the dollars that you can get. They used to be very rigid about what could happen, who could own the property, how you could own the property. They really evolved into understanding that you may want to put it in your dog's name. We don't care because we're going to take everyone's guarantee. Okay. So the SBA has become more flexible and understanding about what the people need as opposed to saying, look, we're the SBA, you do what we tell you. So I think that's probably been the biggest change that I've seen.
And at the end, does it really matter? Because like you said, you're getting the guarantee from everybody.
Everyone's guaranteeing.
Yeah.
So how Joe can hold title to the building for your business. That's fine, but you're guaranteeing it.
Right.
So you better like Joe.
Right. Right.
What's so what products, just for people listening, what products are you guys doing? I know there's a 704.
504 and a 7A.
504, see, I don't even know.
Close. You got close. We'll
All the
take it.
numbers.
I don't do it. Can you explain if that's what you guys do, if there's anything else, and like what's the difference between the two?
Sure. We focus mainly on real estate loans. So the two programs that SBA offers are the 7A program and the 504 program.
Okay.
The main difference is the 7A is more aggressive. It's generally a variable loan. The 504 is a little harder to qualify for, lower down payment, fixed rates. The 504 also has a longer prepayment penalty. So that's the two. When I'm talking to my clients, that's just kind of the nuts and bolts of it. The 7A loan can be used for any business purpose. You can use it to buy a business. You can use it to refinance debt, buy equipment. There's a lot of things you can use the 7A for, but we primarily do real estate with the 7A loan. Generally, with the 7A, you're putting down at least 15%. With the 504, you can put down as little as 5% or as little as 10%. So those are kind of the quick and dirty differences between the two programs.
So do you get to choose, like, since you mentioned for a 7A, for example, you can get a business loan or you can get working capital maybe or things like that, but you guys primarily focus on the real estate. So as a business lender, can you just decide we really just want to do loans against real estate? So somebody else might do a 7A loan for you to buy a business or to get working capital, but we're primarily just focused on the real estate.
Correct. We will do some of the other lending right now. We're kind of branching out into it as a bank. I'm familiar with it because in my career I did a lot of that. That's how I started. From the 504 then into the 7A, doing a lot more business loans as opposed to real estate. So we'll do it, or we'll help them find somebody that will do it. So we're open to that. But our focus is commercial real estate, owner occupied.
Got it.
Those types of loans that you're mentioning, non-real estate loans, they become a lot easier if you have other collateral. So
Right.
you can do those loans, and we'll do those loans, but we generally want collateral.
Yeah. It makes sense. It's like, what else do you have besides real estate to.
Yeah.
Well, but the SBA program is designed. The SBA guarantees 75% of the loan under the 7A program to the bank, so it minimizes your risk. So a lot of lenders will give you an unsecured loan for, say, $100,000 because they're only risking $25,000.
Got it.
So it's available. It's just not something that we're really specialists at.
Got it. Yeah, it seems like once you have a small business, like within a couple of years, all the banks are calling you with their lines of credit that they want to give you. So that makes a lot of sense. And you can kind of get, from what I've heard, I think it's like 50,000 pretty easy. And then over that, then there's maybe like paperwork that you have to give, but they'll kind of just give you 50 grand if overall everything looks good.
But yeah.
Credit score. There's a lot of credit score programs where that's just, and SBA dabbles in that. They go in and out of programs like that where they'll want the banks to do it. And they'll do a credit score program where they'll guarantee it. And then the banks that get into it are usually the larger banks. And after about 3 or 4 years, they take massive losses and get out of it because it's unsecured.
We had a line of credit too for one of our businesses. And the weirdest thing was I used it pretty like regularly for a while. And then I paid it off and we didn't use it for a while. And then I was going to go to use it again. And they said, your line's been closed. Call your bank. And so they said, oh, well, we didn't tell you that after a period of having the line of credit, if it's at zero balance, we just close it. We don't even tell you. So that was, I think it was an SBA line of credit as well. But I thought, okay, well, nobody ever told me that. And how would I remember 3 years down the road that they just automatically close it if it's at zero balance?
It was in the paperwork.
Right?
Yeah.
It's somewhere in that, those 24 documents you signed.
Exactly.
It's there
somewhere.
But you're right. They should have said, hey,
it's
do
a
you
weird,
want us to close it?
Yeah.
Right? Do you want to keep it?
Yeah,
I mean,
it's a weird loophole, but apparently that's one of them.
So who are you guys? I mean, I know what you guys, you guys are, for a lender, there's obviously a lot of options for SBA, but you guys, to be transparent, you guys end up getting a lot of people that are going to a major bank that's more focused on, well, I heard they have the best rate and the best terms for SBA, so I'm going to go there first. And they don't realize they might have problems or some weird scenario, and that bank's going to be like, yeah, I'm glad you heard this, but we have a little small bucket here, and you don't fit it, and you got to move on.
Right.
And they end up coming down the road, and sometimes they land at you. Yep. What kind of clients are you guys, you're helping? What are you guys kind of seeing out there right now? Like, what are you guys seeing, or what are you guys doing a lot of right now? Joe.
Types of businesses,
and then why do you think people land at you? Like
What's your niche?
Yeah.
Oh, the niche. I mean, like you said, they go to a big bank. They don't fit that box specifically. And I would say we don't necessarily have a box. We have this kind of moving target. It's a little bit more flexible. The edges bend a lot more.
Why is that with you guys?
Because we have, I guess, a little bit more ability to look at the full story. Big bank, they're just churning.
They wrote guidelines and you just follow them.
They're churning and burning, and
it's
business. Such a big business that they don't have the access to the chief credit officer or the person actually making the final decision. Where
interesting,
we can, call them up, text them, email them, in person.
You're gonna get his attention.
Yeah, we'll get him, and Steve obviously has a ton of experience in the business too, so we know pretty quickly.
You kind of know
this is a deal
at this point.
Yeah, we kind of what we can and can't do. We like to think of ourselves as problem solvers.
Okay.
Because we're not the ones you're going to come to when you want to get that super good rate.
Yeah.
And we'll be happy to send the client to the bank that will do that.
Yeah.
I mean, I've looked at financials, opened it up, and said, yeah, you need to go talk to my friend over at Wells.
Yeah.
Or at Chase or whatever. Because from what I'm seeing, you're going to qualify for that. And if you don't, call me back. But let's not waste each other's time and let's not be unfair.
Yeah, because if they go down the road and then somebody tells them you could go here, you just wasted your time. You're like, I already know.
They're going to find out anyway.
Cool. Right. So that's nice of you. I mean, and you've been doing this long enough. You're like, I don't need to. I've already wasted my time.
I mean, unless you have to close quickly. Like, for instance, we can close. The fastest thing we've done it without reports is 2 weeks.
Yeah, 13 days is the
So
fastest.
somebody had the reports.
That's fast.
Nothing.
Oh,
no, zero. We had to order appraisal, environmental, and we closed in 13 days. It cost a lot of money.
Oh, because the rushes.
Yes.
Yeah.
Yeah. So we can do that. Generally, we pride ourselves on saying we can close in less than 30 days.
That's
and
fast.
that's good to know though, because a lot of people who are used to SBA will go like, oh, but it's this long process, right? And it takes forever, and not really. It doesn't have to anyway.
That's the very common misconception. Everyone comes to us and says, oh, I had this one SBA experience. Well, they probably had that one SBA experience with a bank that either doesn't do a lot of it or has those more strict guidelines. And it was a 6-month process because they always needed to back every piece of information up with.
It's a pain in the ass to get the best rate and term, right?
And that's more.
Right. Even if you're strong, they want it all.
It's a time suck.
Yeah.
But you look at the end game and you say, okay, look, I'm going to get a rate that's 2 points lower.
Yeah.
It's going to take you probably 100 hours of your time. Is it worth it?
Yeah.
With that? And if it is, and it probably is, because that's a good rate. You
Yeah.
should probably do that, but understand you're going to spend 100 hours.
Wow.
And if you have someone doing it for you, then okay.
Yeah.
That's fine.
Yeah, I just spoke to a client this week who was going to be opening a restaurant or something. She bought some building and she was like, oh, I need a construction loan. And I'm like, yeah, the construction loan is probably going to be a lot easier than the SBA loan that you were moving forward with. She was like, I know, right? So it's like, it sounds like
Especially restaurants.
residential and SBA are two similar beasts, because when it's like multifamily or investor stuff, it's pretty easy.
Yeah.
So Joe, what would you say? So people are coming to you guys that basically they have a piece of real estate, they own the business, and they need to just do some financing or buy a business with real estate. They're going to probably start at somewhere where somebody might refer them to go get the best rate and term. Mm-hmm. Why are they landing at you? What do you think the common problems are of why they're getting denied?
The common, I mean, the
They don't qualify.
the reasons are everything. I mean, anything could be the reason. I mean, the certain debt ratio that they don't meet. I mean, ratios that we're not necessarily as concerned about. I mean, Steve can comment as well, but I think we primarily look at cash flow and collateral. If we have those two, if there's cash flow and there's sufficient collateral, whereas I'm not looking at the debt to income ratio or different things on a balance sheet that Wells Fargo does 10 different formulas with. So
Yeah, even some like the most competitive banks that we've worked with that do owner user stuff have a very specific way that they underwrite the tax returns. Yeah. And then let's say you have a business that didn't do very well 1 year out of the last 3, then they'll say, okay, well, we average that out and it doesn't look right. It's not okay. Or if you have a newer business and they don't have the 3 years returns, they won't accept it. You have to have a minimum of 2. Sometimes you have to have a minimum of 3. So there's other reasons that you go to people like Joe and Steve where you'd get a little bit higher rate, but you can still achieve the goal that you're trying, whether it's buying a building for your business or refinance or whatever. But sometimes it's like a lack of history. Sometimes it's like the income wasn't quite strong enough 1 year. So it sounds to me like you guys are able to kind of look at it and just common sense go, okay, well that year it's because X, Y, and Z. Okay, that makes sense. Let's move forward.
exactly
Approach.
common sense lending.
A story, we call it. It's a story lending because you look at it and say, well, what happened to you in 2017? Here's what happened. Here's why. Here's how I fixed it. And we're able to look at that. I mean, we don't have a credit score per se. We like it to be over 600. Otherwise, it gets really complicated because we have to really do a lot of explaining. But if we understand why it's there, I mean, we've had clients that I look at their credit and it should probably be sub 600 and they're at 700. I look at a client that's got a 620 and I'm like, that's impossible. You're great.
Something's wrong.
Sometimes it's like a lack of credit or like some medical collection
is a big thing.
So we don't
That'll
really,
pull you down.
So we're not driven by credit score. I will say one of the funny things recently, we had a client that was declined by a big bank because their bankruptcy credit score was too high. Did you know that there was a bankruptcy credit score?
I didn't know it existed.
There's a bankruptcy credit score.
Wow.
And it's impacted because he's about 32 years old, doesn't own a home, but he does own a commercial building. He has about $100,000 in revolving credit card debt every month that he pays off with his business. So yes, his score's completely skewed. And they said, well, his score's like 300 points higher than it should be. I'm like, well, yeah. You should throw that out because that makes no sense for him. Because where he is in his life and the fact that he doesn't own a home. Nope, he's declined.
He wants his airline
good
miles.
for me.
So the question then is, it's the SBA is more, since you guys are taking these deals to the same channel, right?
Yes.
Everybody's going to the same.
Generally speaking, on the 504 program, there's a CDC.
Okay.
That there's a bunch of private nonprofit corporations. I can do this because I work there. Private nonprofit corporations licensed by the SBA to underwrite and manage the 504 loan program for the government. Okay. So everyone's going to the same channel there, and they all have to go through the SBA to get approved. So that's all the same. It's like Switzerland. Yeah. You're all going to have to get there.
Same rates, same approval authority. I mean, they can underwrite it their own way and tell their own story, but SBA has to approve that.
And that's for the 40% portion on the 504, the second trust deed. On the 7As, most of the banks are what's called preferred lenders, which means that if we approve it, we just have to go to SBA and they give us a loan number. And there's just a little basic background that they'll check to make sure the client hasn't defaulted on any government loans in their lives, if they that they still have some SBA eligibility available. They go in, they do that, they give us a number. So SBA doesn't do any underwriting on that. So from a 7A standpoint, a PLP lender can kind of do what they want within the guidelines.
Okay.
On the 504, it's all going to end up in the same place.
That's
So if like a Wells is doing it, that's going to give her a better term, and they just can it from up front saying this is not for us.
Right.
That's not saying that SBA wouldn't do it.
Exactly.
So if a client goes, "Oh, I can't get approved," they're just like,
Yeah, I can't approve for my SBA. I'm like, no, you can't get approved at
By Wells
Wells
Fargo.
Fargo because of and it
they're
was-
stringent. Yeah, that's why they're getting the best terms.
Your
Yeah.
credit score is 620. Their minimum is 640.
Okay.
You're declined.
Okay.
Period. Doesn't matter.
So does the SBA measure too, like the success of all the loans that you're doing as well? Okay, so like depending on how many loans go bad or whatever, then you could have your kind of, I guess.
Our PLP could be
PLP.
Yes.
Yes.
Okay.
Yes, we could get slapped.
Yeah.
Really hard.
Yeah.
So
Okay.
Yes. We are regulated by the SBA. We're lucky because we've been doing it a long time and we have a good relationship and we have a good record. So we only get reviewed about every 2 years, officially hardcore. About every 6 months, they do some general reviews. Some banks get reviewed more often based on the numbers. What percentage of your
record,
yeah? How many
experience.
loans did you do that defaulted in less than 12 months? 6. We'll be there tomorrow.
Yeah.
Right.
Wow.
Yeah.
They don't like early defaults.
No.
Well, it's a bad thing.
Is
That
12
means-
months the big? Is that the?
Yeah, that's a bad one.
That's
It's like you didn't properly screen up front.
What,
Yeah.
what did we do wrong if we approved this and it
Yeah.
defaulted in 12 months? We did something wrong, clearly.
Right.
And sometimes it happens, right? Somebody got some. It's happened occasionally.
But it shouldn't happen a lot.
No.
Yeah.
So just because you're doing tougher deals does not mean that somebody's going to default. That's not really. It just means that you have to have more common sense to underwrite them.
Yes.
Okay.
And you put other standards in place, I guess. You might take outside collateral, which we'll do in certain instances, not always, but you make sure that they put skin in the game and they're serious.
Is there any businesses that you're not like the SBA in general or whatever is just like not going to do?
Sure. There's certain businesses that are not eligible.
Yeah.
Gambling.
Okay.
If it's strictly religious, if it's nonprofit, I can't even say the way they say it. Basically, if it's sexual oriented, they won't do it.
Okay.
Because of the federal laws, we can't do anything related to pot.
Okay.
So those are ones that just are not eligible.
Yep.
I've heard some
Period.
talk that they might start considering. I read an article.
Well, the feds have to declassify the drug.
Yeah.
Aha. So as soon as that happens, then they'll open it up.
Well, somebody from the SBA said they like to because the financing that's available it's hard because it's all
hard money.
private. It's
Super
crazy.
expensive,
And
It is.
SBA could fill a gap, and it's actually not a bad business, but they're just like, and right now,
Well, I
there's
guess
too
if-
much. It's
yeah.
politics right now. That's what it is.
if you would fund like a tobacco business or
We would.
alcohol,
could do liquor stores.
yeah.
We can do
You guys do
So this would just
beer
be another thing.
companies?
Sure. We can, and the SBA recently allowed us to do businesses that are hemp related.
Okay.
So they're moving as close as they can to the line, but it has to be further up the food chain for them to be able to do marijuana.
Got it.
But
Just time at this point, right?
it's time.
Yeah.
What so what can somebody, I guess, if somebody's gonna buy a place, what can they expect? Kind of what's the process, Joe, if that's you, whoever.
Yeah.
what-
If you're buying a building for your business,
what,
let's say.
what are you looking for? What's the process? What can they expect? And then, a timeline you get said 30 days, but sometimes that might be fast because some people don't. I always say
It depends on the
people
borrower.
go, consumers, how fast you close? I go 21 days. They go, great. I go, but it's not on us. It depends on you.
exactly.
If you take
How fast-
2 weeks to give me a thing that takes 2 hours, we're not going to close in 21
If
days.
I ask you for something and you give it to me next week, well, there's another week on our
Exactly.
timeline. So, yeah, I mean, we could close in 6 months from now, but if you're committed, 30 days is realistic.
And do you guys do, like, I know I asked you, but to add on that question, do you guys do, like, if somebody wants to buy a business and with the building and everything, and can you pre-qual somebody, or do they just have to get in a contract? And
No,
come
yeah,
to
you could pre-qual them. It's just how much time do they have? I mean, a lot of times other people
what
are
it is.
looking to buy that business as well. So you probably have to get into contract as fast as possible.
And some people are a lot more organized with their paperwork than others. Some people, you send them a list and they have it right over to you. Other people are like, somehow they can't find their tax returns and they don't keep up their financials and they got to put it together, you know?
What's amazing to me is, you know, we're not always the first option, and that's okay. We know our place. But they just gave this information to 3 other lenders or 2 other lenders, and they can't just hit forward on the email to us. So somehow it still takes a little bit longer. But generally speaking, 45 days and 3 years tax returns, personal financial statement. We need personal and business returns, so we do a global cash flow. And generally speaking, I think we need to hit a 1.15 debt service ratio, and every bank's different. So again, a big bank might not hit that coverage, and we might.
And their 1.15 is probably our 1.4 at the big bank, because they underwrite very much more
a lot more
stringently.
conservatively.
Yeah.
So people don't know what global means.
Yep.
You basically, something could be not so good, something can be good, but globally. So can you kind of describe what that means?
Globally means a combination of both personal and business debts. So cash in, cash out, personally and business. The business might be making $1 million a year. Top line, everyone always talks about revenue. Really, tell us, how much money did you make?
Yeah.
So don't, for a borrower, if anyone that was listening to this podcast, we're concerned with your net income, and generally speaking, the overall cash flow is not dependent on gross revenue. It's dependent on net income
and expenses.
Yeah, and then and your net income.
It's your income
comes
minus your
after
expenses.
expenses.
Right.
But you guys could. The other thing is with you guys, there's common sense. Let's say I own a business and I just went and rehabbed it or upgraded or this, and I put in $350,000, and you get it, and it says, "Hey, I've showed $150,000 net, but really I'm at this. But there's just all this. You do add backs. You do. You guys, there's common sense.
Yeah, you would on the tax return. It states repairs and maintenance, $350,000. The year before, I made $0 on repairs and maintenance. So this is uncommon in nature, and I can go back in multiple years and see that. We would give credit for that.
Is there other things you might give credit for in underwriting? Just,
I mean, the basics are depreciation, interest, amortization, rent add back if you're going to move your business. Then sometimes professional fees can be, maybe you had a legal suit or the process of expanding your business took a lot of legal help.
Okay.
And you had a big number there. You just have to, it has to stand out.
Or you did
like if it's for a couple of years in a row, then obviously you're going to say
It's reoccurring.
no.
If you did
But if you see a big jump, then you're like, okay, this
like a
looks
deal
like
we're
capital
working on.
expense.
I'm not gonna say, but like one year I know she's like, hey, I had to go put in $50,000 to build a website and this whole thing because I went online.
Yep.
I do that one time. You could say, hey, you can go back. It's a one time.
Yep.
But a lot of other lenders don't do that.
Yeah, not necessarily.
They're not gonna go get that.
They're not going to
Granular. Yeah, they're
exactly.
not.
Exactly.
Yeah.
So once they get all the paperwork in, let's say they go in, they get in a contract, and obviously it's usually for most people that haven't been through this, is a little bit nerve wracking. It's their first business. They're coming to you. They're like, they probably have maybe some issue with their stuff because even if they're new, it's even hard to go to because sometimes those people have issues. I just feel like people do, I just feel like
Everyone has them.
Yeah. They're under a timeline to remove contingencies and stuff in this business. How long is it going to take up front to know, hey, Joe, I'm giving you this. We're going back and forth. So I know we're
approval.
good to go.
Yeah.
So generally, I would say within the first week of submission, we'll know we're going to be doing this. We might not necessarily have an approval, but it's been vetted and it's been discussed.
You
and
feel pretty sure about it.
You feel pretty sure. I'd feel okay starting to spend some money, but
Who vetted by? When you mean vetted by, to more detail.
Underwriters, the credit team. So
you guys will look at a file.
The way we look at it,
Yeah.
and we can pre-qual clients as well. So we can look at it, and you can come to me and say, how much of a building can I afford?
Okay.
So give us 3 years tax returns. We can really get into it, analyze it, let you know within 48 hours.
That's pretty good.
If this is what you can afford, or you qualify for that building that you just put under contract.
Okay.
We'll look at it, and at that point, we'll give you a written proposal if we think it's something we can do. And we're pretty good at performing on the proposals when we review it.
And is this something at your level you're doing,
Yeah,
or you don't need me to reach out? You're comfortable with your experience.
Right. And if we need to reach out, we will.
Okay.
And we'll tell the client, for instance, we'll look at it and go, this is going to take a little extra work. You're going to have to pledge additional collateral. You might have to put more money down. Are you prepared to do that?
Here's worst case scenario. If you're good with that, then let's just keep going.
Right. And we'll do the best we can. But this is, you may have to put
Is-
your
and
Loan
you're-
approval is essentially like right before closing, right? I mean, you basically Okay.
No, typically 2 or 3 weeks before closing.
Got it.
Because we generally don't like to spend a client's money, even though we'll collect money up front, until we know we're going to have you approved. So I don't want to order an appraisal until I know it's going to be worth ordering that appraisal.
So if you're on a kind of fast track, you could get an approval in as quickly as 2 weeks from getting all the paperwork to maybe
less
like.
than that. If it's a fast track, I can get an approval in a week.
Okay.
3 to 5 days.
So then more realistically, maybe like 2 weeks. If
2 weeks is
you've got
normal.
somebody who's like going to take a day or two to get you paperwork
Yeah,
or something.
and that's always the pushback is
Yeah.
I need, what's this question? Oh, let me talk to my CPA. CPA is busy doing taxes because it's always
Yeah.
April 15th or something.
Yeah, when they've seemed to buy, right?
It's always, or
Or
they're
we're
just got
leaving
done and they're on vacation.
Yeah, we're leaving town. Hey, can you do this by this date?
We're going on vacation.
Yeah, we're going to Pakistan for a month. But okay.
So question is one of the things I was going to ask you is, so somebody gets their stuff in, you can review, get back to them, and then you came back and said you might need additional collateral and stuff. Why would somebody need additional collateral? Like, what is with the file that you're looking at, on top of your head now? Like, what are the things that pop up that somebody needs additional collateral for?
It could be a projection-based loan. Let's say you're buying a second site and you just don't cash flow. It's a total risk. So we're taking a risk with you.
Wow.
So we're going to want to get our 15% down. This is typically on the 7A loan. The
Okay.
504 loan generally doesn't take additional collateral.
Okay.
That's usually just a straight purchase, 10 or 15% down, depending on the type of building you're buying. With a 7A, we may look at it and say, okay, you want to buy a second restaurant. It's a great example. I want to open up a second restaurant. It doesn't cash flow, obviously, because
You don't
you're
know.
gonna
Haven't opened the
double
restaurant
debt,
yet.
Yeah.
right? So we'll look at it and we may say, well, you're going to have to put 20% down, and we're going to need another 20% in collateral or cash, which can be your house as additional collateral. That gets us to where we're comfortable making this loan and getting you into that new site.
That's
So
always been a challenge for me too, though. When lenders say, "I want your house as collateral," that's a touchy one.
it's a real touchy one. It's
Yeah.
a touchy, but
And
on
when
the
you
other
say
hand,
cash, how could you do that? They can put cash in your bank?
sure, they could cash secure it, but then you're better off just paying the money down,
Right.
Okay.
Because then you're not paying interest on it.
Okay.
Right. So you can say, look, I don't want to put my house up. All right, then give us another 15% down. I don't have the cash. I know. That's why you have to put your house up, because you don't have that much cash.
Okay.
It's a risk.
Kind of comes down to one of those things. Like I've had that conversation with clients before. If you really believe in this, this is what you got to do.
Yeah.
Yeah.
Yeah. That's
It's
what
scary, I know, but
we
you
always
know,
say you got to have skin in the game.
yeah.
So the additional
So-
collateral is really probably mainly a cash flow issue.
Yes. Cash flow credit.
So if cash flow's good, credit's bad, they could go, like
you don't typically pay your bills on time. Let's be honest.
that's a problem for us.
Yeah, that's a real challenge here. You don't pay your bills on time. So if we do this, we're going to take your house as additional collateral to make sure that if you're not paying us on time,
And is this SBA requiring that, or you just know
we
they're
do.
going
Yeah,
SBA
bank.
requirements are very simple. The SBA, I probably should have said this up front, on a 7A loan on a real estate purchase, you have to take 15% down or pledge additional collateral.
Okay.
So if you put at least 15% down, you don't have to pledge collateral by SBA rules.
Okay.
The 504, 10% down, or if it's special purpose, hotel, gas stations, things like that, require 15% down.
Okay.
That's it. That's the down payment.
Now, Kenny, if somebody's going to put up their house as additional collateral, could that cause a problem for you if they wanted to like refi, even if it was just to reduce the rate, or how does it come when it comes to
Well, no, I mean
subordinating?
it's look, if you're refinance your house, I mean it could be a problem for both. Let's say they want to do rate and term, they might ask him to lease it, put it back on. I don't know if they can do that. Probably like
How does that work?
Typically not.
yeah.
So, we have workarounds that we do. I mean, obviously, there's some lenders that will do it, but they're far and few between. So generally, you're kind of stuck with it.
I was gonna say for a cash out refi in your house,
Then forget
and
it.
I'm calling you. He's like, no.
Yeah,
no,
right.
Absolutely, I get the cash though.
Yeah, exactly.
Yeah,
Yeah.
sure, yeah.
Yeah, you're biting down your loan more, right, or something? Yeah, because there's no way. Like,
Right.
that's a problem. So, I mean, even though it's Fannie, Freddie debt going to the
basically,
government, they just don't care. They don't
Hopefully
talk.
you've got the rate that you're happy with on your house, and if you're putting it up for collateral, you just know that until you release that as collateral, you're probably going to keep
So
the
that's
same.
another question. Let's say you put a house up,
Mm-hmm.
a primary investment property. You guys wouldn't care as long as there's equity.
Right.
And they go to sell it. and you've got, let's just say, if you tap that house for what, an extra 15% or something, is that typically what, or depends?
And you could put a blanket lien on it.
Let's just pick a number. So let's say the house is worth $1 million and they owe $500,000, and you got to tap it for $200,000.
Or they just go to sell it and pay off. What happens?
They have to pay
they
you
pay down
guys.
the loan.
How does that work?
A good question, and it's a big depends because it depends on time. The house, I look at it like it's an Easter egg in an Easter egg basket, and we have it, and we don't want to give it to you. But as it gets older and the eggs aren't as nice, we might be able to give it up. So if it's more than 2+ years, everything's looks good, taxes, you've made your payments on time, credit's still good, we can do something. We might be able to take less money to let you sell it. So maybe you could pay us, let's say it's 200, we might take 100 and let you go on your merry way. We can also just, if you're going to exchange into another property, our lien will just follow. So you can go buy the other property and we'll just tag along with it. So there's ways that we can work with you. The longer the time frame is, the better.
The better.
Okay.
If it's 1 year, it's not going to happen.
You're giving,
Yeah.
but what do they give you? You're going to take the money and
Yeah.
pay down the loan?
We could, yes.
Okay.
By that amount.
But
Yes.
basically, you want to see some history with the client, like
Would there be a
basically paying.
prepay?
There's a prepayment penalty on the 7A loans: 5% year 1, 3% year 2, 1% year 3.
So if they're paying you down, let's say a little bit, they might.
You can pay 20% a year
Okay.
with no penalty. 20 or 20. 20.
So they'd have to just see what the loan amount is and see if that's going to hit it.
Well, what we typically do there is then let's say that it's going to be more than 20%. We'll pay the 20% down now. We'll
Hold the money.
escrow the money until the next year. So that
Okay.
it's not fair.
But you guys are in control of the money, though.
Yes.
Okay.
But it's
cool.
not fair to you, the client, to have to pay a 3% penalty. It's like, oh yeah, you got to pay us down by $200,000. Oh, and we get another 20. Thank you very much.
Right.
We understand. We're working with small businesses. Things happen. You need to move. You get a bigger family, smaller family, whatever. We want to work with you, and we are able to do that as long as you're making your payments, right? That comes down to everything else. It's like, hey, I'm going to sell my house, and I would like you to give me the money. You've been late on your payments for about 10 times. It's not going to happen.
That's basically like they cooperate and then you guys cooperate.
Yeah.
Yeah.
So, Crystal, why are, because you guys do owner user loans.
Not very often.
They're
but
not all
still.
SBA. So, why is somebody going to go, and this could be a question for everybody, why is somebody going to go SBA over going just to a traditional bank, whoever you guys use, and put the 10-15% down? What is, like, somebody, if somebody's listening, what is the differences? Obviously, I know there's terms and all this, but why would they do one or the other?
So sometimes we have businesses that are really strong, well established, great credit, good liquidity, great. I mean, everything's great. And they qualify to not have to go through SBA. Sometimes SBA fees are higher than what you would get with just going straight to a bank. So then they would get usually a lower rate, but if they're purchasing a building, they might have to put a little bit more money down than SBA would require. But if they're a strong business and they have the capital put down or they want to put it down, you can get like a smoking deal on a rate. So what we have done sometimes is where if you can get the really good rate, a lot of times it's a 20-year AM versus a 25 though. So, but the lower rate a lot of times is about the same payment as they would pay on an SBA loan at the higher rate, but they're getting that principal reduction.
Yep.
So if you're a strong business, you get that. You're like, okay, well, I'm paying down my loan faster. I put a little bit more money down. I get a better rate. I get to pay down my loan faster. It's a huge benefit. I would say there's not a ton of businesses that qualify for that, but it happens. So,
No, I know. I mean, I know that you've run businesses, and it's like those banks that do them are very picky.
They're very picky. They want banking relationships.
They want your banking relationship.
And they have a very square box that has
It's
no
worse than a Wells
flexibility.
SBA loan square box.
It is, but
Yeah.
Great rate.
Yeah.
Really good rate. So,
You
and
gotta
that's why,
qualify.
though. I mean, and I'll even say, like, our bankers that do those deals are not super busy, because they're just like getting the
But
cream of
they
the
are,
crop.
but they're
tip
more
the-
of like
yeah.
business bankers. That well, you're not.
Right.
Yeah.
They're in charge
they'd
of
have a
the
tie-on.
money and this.
They'd have a
Exactly.
tie-on right now.
Yeah,
Yes.
they don't have.
Even though it's Friday.
They do.
Yeah.
I mean,
Yes.
the magic pixie dust in the SBA loans is a longer term, a lower down payment.
Yeah.
Right. You can get a building for 10% down.
Yes.
So, and then
Oh, you can do a 25-year term, right? Or
Well,
We do 30.
Well, we do 30. The 504 loan is traditionally called a 50-40-10. 10% down by the client, 40% by the SBA,
okay.
second lien position, 50% by the bank, and first lien position. That's why the bank likes that loan. We're at a 50% first trust deed. We can do within reason whatever we want on the first trust deed as far as rates and terms go. We do a 30-year amortization because our rates are a little bit higher, and that kind of balances out the payment. Reality clients, they're not stupid. They know they're paying the money, but it's just over 30 years instead of 25, so the payment's lower. The SBA portion right now is a 25-year fixed at
3.48.
It's really good.
That is
for
unbelievable.
25 years at 10% down.
It was that cheap 30 years ago, right?
This is actually the lowest it's ever been.
Is it?
Ever. Yeah,
What was it 30 years ago, probably?
Oh, jeez.
Did the 504 even exist 30 years ago?
They had a 50.
No, I'm just saying SBA rates in
I'm
general had
giving,
been.
he's giving me a little grief. There was a 502 and a 503.
Okay.
Now there's a 504. Yes, the rates were probably. I mean, I've seen them up in the 6s, 5s. This is the lowest it's ever been.
Even a year ago, it was in the 5s. So,
Wow,
That's
crazy.
a lot better.
No, I remember when the client we were talking about sent it over, and I was like, "Is that right?"
Yes.
that's good.
I was like, "It's like, yeah." I'm like, "Is that really?"
And again,
I was waiting. Where's the add-on for the index or the margin or like?
Nope.
that's it.
That's crazy. So a blended. So if people don't know, then you guys more look at a blended rate.
Yeah. I mean, you could.
No, because it's like 50-50 almost, and you blend it. This is kind of.
Well, now you're talking how we're selling our rate because it is, But the reality is the blended rate's probably under 5.
Yeah.
I mean, you're going to look at a very strong blended rate, but that, I mean,
At
that
10%
money-
down.
yeah.
And then your rates are higher because you're taking on more risk.
Yes.
And that's what it is.
And honestly, the 30-year AM versus the 25 that you guys give is really helpful because I tell clients sometimes are so sensitive about rates. Like you tell them the rate and they're like, oh, that seems high. And I'm kind of like, what? You just look at your payment. Can you afford this payment? I mean, you're trying to get into this business and this is what you need. So take a look at the payment. This is, maybe 3, 4, 5 years from now, you can be in a position to refinance and get it once you've got a track record and some tax returns and all of that, better tax returns. So it's like it comes down to the payment that you want to have.
Right.
Yeah, but a lot of people that you take to a traditional bank, they love the rate, but they're like, ooh, 20-year AM, and it's still scary because
Right.
it's
That's what I say to
20-year
people
AM.
too. Yeah.
Well, and 35% down.
yeah. In a small business, it's
It's a
kind
lot
of
money.
tough.
Right.
Yeah.
I mean, the idea behind SBA is to keep the money in the business. The business grows, they hire more people, they pay more taxes. Ta-da!
That's what they want.
Program rolls, right? That's
Yeah.
what we're all about.
That's really what the program's about.
Yes, it's creating
Yep.
jobs. Bottom line for SBA is to create jobs. That's what they're looking for. They monitor it it's interesting. That's one of the statistics that used to come from the SBA 504 program about how many jobs were created. That was what reported and told you how many jobs were created under that program.
Oh,
But
really?
Yeah, it's more sophisticated now, but when I started, that was the place they went to get the number of jobs
Interesting.
created.
Question for you is during the last downturn, the financial collapse, whatever we're going to call it, how was business then? Meaning,
It sucked. Nobody was lending ever. Generally, with SBA, we're the ones that are almost recession-proof because then the lenders stop lending unless they can get that enhancement for the the SBA guarantee. So up until the big one, whatever you want to
Great
call
Recession, we'll call it.
Yeah,
whatever.
right.
Yeah.
everyone stopped lending. Period. Prior to that, I went through some
Is
recessions.
that the worst you ever saw?
Oh yeah,
This last one for sure, huh?
For sure. We went through some, and this is not probably great, but it's better for us when we have a recession because we're the ones that are lending and we're able to lend. So it makes a big difference.
And you guys are still not.
Nobody.
Well, think
So
about it too, though.
business- so-
Businesses were doing worse. So then
No,
you're
but
looking
what I'm
at
saying is like, ways
all
why I
these tax
ask
returns.
is, I think people wonder, like when we hit a recession, it's that bad. You guys are probably the last of the line that will lend to businesses.
Yes. Yeah.
And you're saying, even just 3 years, we weren't lending. That just tells you that nothing was going on.
Correct.
There was no new business. I know people didn't want to buy them, and even if they did, it was like almost impossible.
Yeah.
But let's say you wanted to refinance your business and things. I think it's just difficult because even back in that time, a lot of businesses were suffering. So when they were looking at the financials to even see if they could possibly do the loan, you were looking at declining income.
No income.
Yeah.
Nobody was making money.
Right.
But coming out of the recession, whatever you want. Again, it was worse than a recession. Coming out of that, the SBA programs were one of the leaders that started to lend to businesses.
When was it bad? Just out of curiosity, like time wise, was 09?
I can't remember.
2000 was
I try not to
was
think.
2009 like where it kind of
Probably
just
8 and 9 were just.
so 10 starts to come up. No.
No. Probably closer.
Remember, we were doing loans.
No,
and
I'm asking.
So in
So you had like
2010,
4
it was
years.
rough.
It was just
about 3 years of just, it was very difficult to help any clients. I mean, and it made sense for some of them to buy buildings. I had a couple of clients that got buildings that were, it appraised for like $1.7 million.
It's cheap.
It appraised for $1.7 million. He was buying it for $700,000, and we were struggling to get the loan. And he's like, "Is this appraisal right?" I'm like, "Yes, this appraisal's right."
Was SBA tightening or no? It was just
The banks,
You guys.
SBA would
They're
love
always
you to
ready.
lend. They were out there going, "Come on, guys," and we're like, "We don't have any money." The other side of the government, the regulators, are strangling us because we don't have any money, right? That's what happens.
That's crazy.
Yeah.
So the SBA wants
Remember on
it,
the
and then-
investment side, I never did for multifamily. I never did so many Fannie Mae loans ever too, because the banks weren't lending, so people were taking Fannie Mae loans that they would never take today with
Right.
yield maintenance and these crazy
They didn't have a
terms.
choice.
They were expensive and they had the worst prepays, but people would take those loans because if they had to get a loan back in that time, and that was what was available, you just took it.
So yield maintenance is probably like the SBA prepay. It's pretty ugly, I'm guessing.
The SBA prepaid is easy.
Oh, is it?
Yeah,
Okay.
the 7A is a 5-3-1, 5%
Oh,
year
okay.
1, 3% year 2, 1% year 3.
That's
On
not
the
bad at all.
504 loan, first of all, on the 504 portion, why would you want to pay that back, right? It's 25-year fixed at
3.48.
Yeah, we tell clients.
So what do people do? They usually refi the first and
Yeah.
just
Yeah.
somebody.
Yeah,
You can,
But the SBA prepayment penalty it's a really confusing formula. But the essence of it is it's 1 year's interest declines 10% each year for 10 years.
Okay.
So you're talking 3% declining for 10 years. Big deal.
Okay.
Right, that's not that horrific.
It's not terrible at all.
And again, what do you care?
Yeah.
Right. Most of the time, if you're getting 10 or 25-year fixed at that rate, the banks want a flat 10 for 10 prepay because you're not going to prepay us anyway.
Right.
Unless you're selling the building and making a ton of money, you're not
Right.
going to touch that
No.
loan.
Oh, there's
Doesn't make
some.
sense.
Yeah. Like you got bought. Your business got bought for a bunch of money.
You're getting
and
out of
like,
business, you're
Right.
retiring,
But
you're
I'll pay it.
whatever.
Well,
Yeah.
but understand one of the reasons small businesses buy their building is because it is their 401k plan.
Right
Because
back.
you keep the building. So when big guy comes in and gobbles up your business, or you sell your business
You still have the real estate.
and you get to charge more rent.
So that's a good. I like that on that topic. So let's say, let's pick a business, Crystal, that somebody would probably buy a building. Think about it. Who would buy a building? Like, give me a business that somebody's in business renting a building that might go to buy
CPA
it.
firms
A
buy
restaurant.
Okay, let's say a CPA firm. What are they probably looking at? Like, if they're going to go buy, it's 10-15% down, right? Let's say they're going to go buy, and a lot of people are like, "Should I buy a building? Why should? Can I even qualify for this?" The first steps really are is they're paying rent now. It's pretty much they just need to be able to, if they're cash flowing paying rent now, they just have to be able to cover that SBA payment and come in with a 10-15% down. There's really not much more past that, right?
Well,
But if there's credit and everything else,
I mean, and also CPA firms kind of depends how the CPA does their taxes too. Because sometimes you're somehow surviving for 10 years and had losses every year.
Well, the
depends
gardener
what
has
you
a
write
crappy
down.
yard, right?
Yeah.
That's
Yeah,
so the
yeah,
CPA
yeah,
hasn't
yeah,
got- But
yeah.
but yes, the essence of it is the biggest challenge for most of our clients is the down payment.
Yeah.
We're dealing with smaller businesses,
Yeah.
right? They're not that sophisticated. They don't have $400,000 sitting around. So it's important for them to minimize the down payment, keep the cash in the business. So you name it. We just did a yard maintenance building out in Palm Springs. It was a big deal for him. He got in for 10% down. That was a great deal for him. But we've looked at a lot of different businesses, and it makes sense for them, almost all of them, to buy their own buildings because it's a long-term play. Your landlord's not going to push you out. You can do what you want with the property. You can improve it and enhance your business. So it makes sense.
It
Yeah, they're
should
not going to raise your rent or anything like that. Yeah.
should comment too that the 10%, which sometimes could be the challenge, or the 15 or 20, whatever it is, it could come in other forms. It could come in a family member giving you a gift. It could come from the seller of the building carrying a note. It could come.
Really?
So you can come up. The bank, generally speaking, wants to see you put something in. 5% is kind of like the number
bare-
that we like to see.
yeah,
The
you
bare
want to see
minimum.
something.
But you can do $100,000 down and a gift for another $500,000 to cover the building if you need.
So you want to see, like me, I'm the individual, put like 5. But if you got to go get 10 from somewhere else or another 5.
Well, you have to explain why you only have 5 and you want to buy this building. Why does it make sense if you don't have any cash?
Okay.
But it could be the story, right? I
Yeah.
put all the money in to do X, Y, and Z to expand, and that's why I need this building now.
So Joe, let's say I'm, doesn't matter, 30 years old. I'm a bartender at a restaurant with a buddy.
Okay.
And we've been working for 10 years, stacking. We have a ton of cash in the bank. We have a ton of experience managing the bar and all this. And I'm thinking 2 to 3 years out that, hey, I want to go open a bar. Mm-hmm. And maybe they have an investor, but they're like, we want to go, buy a building, open the bar, because they don't want to worry about kicking out for a lease. So let's say they have a spot, whatever, in North Park or something. But they want to put minimum down because they got to go in and do the whole bar build out and all that stuff.
And a lot of times your investor doesn't want to go on the loan too. Like they'll be the money guy, but they're like,
but they're also not going to go, we're going to buy the building and give you everything. Like maybe that investor is going to be like, I'm going to do the build out, but if you want the building, so I'm going to buy the building. What should that person, it could be any business, right? But I'm talking about this because I know people have done this, in San Diego. What should that person, number one, could that person that's doing this, that hasn't owned a business, but it's been a bar, run it, and you have all this, is that even realistic for somebody to even have a conversation or think about that?
Sure. Nate, you can definitely buy a business. If you have the experience, it really doesn't matter if you own the business or owned a business before, because you could prove that you can run the business and be successful. I would say from that bartender, and specifically that industry, because it's probably mostly cash, you want to be able to show some income for those prior years leading up to the purchase.
Claim your tips.
Yeah. Claim at least some of the tips. Make it so that you could, all of a sudden you have a couple $100,000 in the bank. How did it get there?
Yeah.
So you need to be able to show, again, going back to cash flow and collateral, you need to be able to show that you can cash flow, or generally speaking, it's a startup business.
And you're going to look at, do they have a car payment? Do they have credit card payments?
We're
do they
going
have a rent payment?
Yep.
So keep overhead low.
Yep.
Like pay off your debts,
Yep.
look clean. You can have a rent, but don't come to you saying I make $20,000 a year and I need to go buy $1 million building.
Yeah. Don't show me your tax return that shows $20,000 yet.
You can't even cover your rent.
$2 million building, and you have.
That happens all too often.
Yeah.
So basically some planning and preparation. But like we said, most people don't do that. Most people come to you and say, hey, I got this great business. We found the building.
Yep.
Here's my $20,000 a year tax
But
return.
we're talking somebody might be listening
can I
that
do?
like is thinking out, I want to do this.
Yeah.
I'm saving.
So we want to plan.
If you can, if you know you want to do that in advance, at least
Start
2
planning.
years, you're going to have to pay some taxes and you're going to have to report some income.
Be less aggressive on your deductions, because
Okay.
there's ways to do it legally and not. But
Yeah.
you can show as much income as you can, knowing you're going to buy a building.
You want to be
It's
lendable,
very
basically.
normal with accountants. They're like, dang, if I'd have known he was buying a building this year, I would have done the tax returns different. I'm like, dude, really?
And honestly, we actually have clients where they'll send us their draft every year just for us to take a quick peek and make sure that they're going to be good on financing. And if not, maybe they don't write off as much, or
sometimes CPAs go in and just go for the gusto, and you're like, hey, can we put this like amortizer? Oh yeah, we get. Well, yeah, you just want to hit them. It's like, well, they want no tax. I'm like, yeah, but they need to do stuff too.
They'll move sales to next year.
Exactly.
A lot of times we can move $100,000 of sales to next year, so we don't have to pay tax this year.
Yeah.
Well, it's perpetual, but if you put it now, then we're going to look better when we do it.
Yeah.
And I should say, I mean, there's ways of not paying tax and still looking good on paper, because you might have had a net loss from the year before. It doesn't mean you can't take that net loss from 3 years ago or 5 years ago when something did happen.
Depends on the bank.
Yeah.
Depends on the bank. Yeah.
I mean, it would
in
be
our,
also
in our
as-
world you can do
It
that.
would also be is if you're going to buy something, make sure you're in communication with your CPA that he's aware of what you're
Yes.
doing.
Yes.
So let's just say, I'm just picking a number. The building's $1 million, whatever. Me and somebody are going to buy it, right? The bartenders. Are they able to buy the building? And then let's say there's a build out. Could they do the whole
So
kit
you're
caboodle?
talking startup, right?
Yeah.
Startup, generally on a startup, you're going to have to put more down
Okay.
because you're starting up. So
Okay.
you do have to have good credit, good experience. You're probably looking at about 25%.
Okay.
That can include some build out, that can include inventory, that can include working capital, but you've got to expect at least 25% into it. So if you're buying a building for $1 million, you need 250 all in.
plus
So-
whatever you're
Plus the build,
in
plus the
yeah.
build out too.
Yeah,
Okay.
so you've got to
Whatever it is.
have.
And so if you're going to do the restaurant, they have a silent investor. How would that work?
You don't have to have a silent investor. The SBA will allow anyone that owns 20% or less of the building does not have to guarantee the loan.
Oh, less than 20%.
Less 19.99.
Okay.
Yeah.
So let's say you're buying a building for $1 million, and let's say that you have Joe wants in.
Yep.
He'll give you $200,000. He wants 19.99% of the building. he can do that and not guarantee the loan. So they don't have to be silent,
Okay.
which got somebody in town in trouble, right?
Yeah, not saying anything.
Not saying anything. Anyway.
We're all gonna have to Google that now.
Yeah. Yes. So it could be above board.
Is that popular?
Which?
Somebody that owns restaurants?
Yeah, we'll talk later about that.
Yeah.
I think I know who it is.
Yeah, you probably do.
Yeah, somebody just told me that story.
Silent partners. There's lots of silent partners.
Yeah, I think so.
Isn't that how you spell Ponzi?
Okay, cool. So basically, startup is just,
It's harder. We do them.
and so because,
Well, it's more risky. You don't have a track record.
so let me ask you a question.
What's your track record?
Yeah.
But they also is, how do you qualify them for that whole loan and business? Let's say they're making, decent money, but you have to do projections on the business.
Correct. But they know what they're doing.
And then it comes down to global cash flow too, because you might be starting a business and you could still be working at your other job too.
Yeah.
And you could have a global
I've
cash
seen that
flow
happen
looks
a lot.
great, and you could have plenty of money in the bank, so it looks okay, but you still have to do projections. And
Because some people start a side business.
Yeah.
And they're okay.
You
then
start in your garage, build it up, and then you get to a point where it's time to quit your job and go do it.
Yeah.
And when can you afford that? And how much money should you borrow to do that? Is the age-old question, right?
But the better time is before you quit the job is go get the SBA loan and all that, or
Probably, it depends.
or do you guys look at it like, how are you going to run both? You got a full-time job in this. Do you question that, or?
it could be part of it. Yeah, I mean that's it depends. Like, does it make sense? Can you do that theoretically? Will there be a manager in place to help you with that? What's your
Because you could
plan?
be like Shark Tank, where Mark Cuban's like, wait a minute, so you're going to work your job in
Right.
this? How are you going to do that? It's
Right.
impossible.
We have-
like, you
we-
guys have to question, right?
Are you
Like,
going to
We
sleep?
do fill out like questionnaires about your business plan and how it's going to be run and all of that. So
And one other thing, going back to being prepared and planning ahead. Again, don't do it always right before you're going to leave town. Don't do it always at the peak of tax season when your CPA can't help you with any numbers. You want to be able to be prepared in as much as possible in advance, because you're going to have to provide all these things. You can't
basically
just
let people know in advance too, so they can plan accordingly. So your CPA, if you give them a heads up, like, hey, in 2 months from now or even 30 days from now, I'm going to be going through this process of SBA loan.
definitely give your CPA, yeah.
Generally,
If it's your
Are you
first time,
available? Can
because
you
you're
be
going to need
available?
him, and you're going to need to get budgets and things like that too. Like, don't come to Joe and say, hey, I want to buy. Well, do you have a budget for business? No, what's that? Like, you got to
But that's our perfect client.
yeah.
Right?
Right.
That's our. They can go. Hey, we're in escrow on the building. Great. Well, let's see your paperwork. What's that? Okay, this is going to take a while.
Yeah.
Yes.
But that's why
what we do. That's what we do. We help you get through the process.
you're problem solvers, as you said.
We help you get through the process. We're not the ones that are going to say your CPA has to fill this out and the CPA is out of town. All right, fill this out to the best of your ability. We'll help you with it, and we'll look at it and figure out what But you give us the numbers. We'll help you figure out what you're doing here.
So you guys are basically, it's like, just kind of like we we're talking about somebody before in here, Ariel or Joe or friend. It's like you guys are, you're smaller, but you're getting, it's like a more boutique service, customer service. I can go to my chief credit officer quickly, get back to you. We can help you with paperwork, come in. We're not going to be like, you don't fit a bucket. We don't have time for you. I've got 100
When you go to
other
the big
clients.
banks, they go like, here, fill this out and bring it back to me.
Yeah,
that's
and
it.
it's overwhelming too for people. Some they're like, I never filled this out. This is crazy.
Oh yeah, we help our clients, with the paperwork because we've done it 100 times. It'll be a lot quicker. You know the information, so we can do it together. But yeah, it is more hands-on customer service when you come to us. We have a lot more options. I mean, not only do we have SBA, we do conventional loans. So sometimes clients come to us because they just want to get in the building. Well, 3 years later, the prepayment penalty is gone. You kind of remove your training wheels of having that SBA loan. We can do a conventional loan on top of that and refinance that loan out.
Okay, that's
So-
a good avenue. Both of you, one of you, however you want to answer it. What do you kind of in closing here? What would you give the biggest piece of advice? Maybe each answer. Somebody getting an SBA loan from your perspective, like what's probably one to three things, biggest piece of advice is to people.
They should call us first.
That's awesome.
Other than that, right? That's it.
No, I mean-
Simple as that. I mean, we're able to help, and if you call us, let us know what's going on. We've got a couple clients that are out shopping for buildings. They came to us first, and
Smart.
we would say this is how much you can afford. I had one client that can afford a lot more than she wants.
Yeah.
And we reminded her you only have to occupy 51%. So you can have a building with tenants as long as you plan on growing into that eventually. That's eligible. So no, it was good that she came to us early. The real estate broker brought her to us and said he wanted to know how much. We pre-screened it for the broker. How much can she afford? And we're like, a lot more than you're showing her.
And then it goes on the flip side of somebody who's looking for more than they can afford.
And
We were like, hey, you want $1 million building? I mean, if you want to do 5, you can get some tenants. And and that's the other thing. You can have tenants with an SBA loan. You just need 51% occupancy.
Which, like you're saying, is we're real estate investors. I know you are. That's a retirement. So if you have the money and go buy a building and those other people potentially could pay your rent for you or your mortgage, that's so much more cash flow.
Sure.
Plus for qualifying, that could be another, for you guys, it could go global cash flow.
Global,
that's huge.
Exactly. And the business technically does have to cash flow the loan, but on a global basis,
it helps.
That's outside income that could pay for your car, that could pay for your home mortgage or other things.
Oh, okay.
Yeah.
That's cool.
So,
but for me, my advice would just be prepared. It's not too early to start. Like that client specifically, she's talking about next year.
But super smart though.
Yeah,
she writes an offer. She knows she can close quick.
Right.
Yeah.
There's no stress.
Right.
There's no.
well, and vice versa. We'll get the brokers will have us pre-qual because they can't ask the client about their financials. So they'll say, hey, you've got to go talk to Steve before I'm going to take your offer. And I'll look at it and I'll call him and go, yeah, don't take it. So I can't disclose anything. I'm just saying no or yes. Simple as that. And it makes it easier for them knowing they're going in that they can afford it. And whether or not we end up with a loan, they can afford the building that they're trying to buy. So that, like I said, they should reach out early and say, okay, this is what I've got. Does this look reasonable? And you're like, yeah, maybe we can work with you.
Because you guys are you're getting people that are in escrow that might have fallen out from a bank or two.
3 weeks away,
and
from
it's being thrown in your lap, and you're dealing with a mess.
Yeah.
Which is what you're used to. That's what you're built for. But people have to understand, if you went to these banks first and got pre-qualified, you would have already been with me. We'd have been ready to go. And you guys can deal with the stress. It's like we always say, this is what we do every day. Mm-hmm. But for you don't do it. Right. You're stressed out of your mind. You're dealing with your business. You're going to move your business. It's all this stuff. Right. We're going to close your loan like we do every other month, every month with somebody else. Right. Yeah. So I think in our business too, being prepared. Not just with your paperwork, but like Crystal, you said, are your P&Ls up to date?
That's a big one for businesses. Small businesses.
I haven't done them all year, and it's October. Well, Joe, you're gonna need those. Yeah, I'm gonna need them. How fast? Now.
Within 90 days for us. So.
Yeah. So I think just being prepared and all the stuff. If you have credit card debt and your credit might be low, can you pay it off before you go in or things like that? So. Crystal, any more questions?
No, I think we covered.
Anything else?
Nope.
Oh, was that you?
That's me.
I was wondering who that is.
It's like, who the heck did
any other little tidbits of information?
No, not really. You got anything?
I think we covered pretty well this 7A and 504 subject.
One thing I would say, and I think we talked about in the beginning, is SBA is not as daunting as some people.
That's the general consensus.
The rumor that they heard was that it's impossible and don't ever get it.
And it takes forever.
Basically, that's bullshit. That's
it is.
It's BS.
Who did that person's loan
that?
before?
Okay.
What bank was it? Do they specialize in this? Is this all they do? Because that is all of our loans are owner-user, conventional or SBA loans. And whether it's conventional or SBA, it's the same process.
I'll be honest. I'm doing a loan. I have a client that Mitch tried to start with the better terms. And then I said, are you going to go to Joe? He's like, no, I think you qualify. And then we went here. And then now we're at Joe. Yeah. And it's a tough deal.
And it's a couple months later.
And, but the point is that, I had it, but there's not really anything daunting about it. It's a tough deal too. Mm-hmm. So I don't know I'm sure there's tougher deals, but it's a tough deal. And I don't think it's crazy or daunting or anything like that. I think it's pretty much provide the information, do what they tell you to do, listen and follow instructions. That's the one thing. Yeah. If somebody tells you what to do or how to get to the final result, you need to listen to these guys because this is what they do all day.
Yep.
But again, that does come down to who you're working with too. So the banker or the person that you're working with that's doing your loan can either make the process easier for you or they can
100%.
make it harder. So, and I do, like you mentioned, some of the bigger banks that might have lower rates just don't tend to make the process super easy. They pretty much throw all the work on you, and then they have all these guidelines and overlays and their own timelines that make you feel like SBA is slow and takes forever and
that's generally
asks for too much paperwork, you know? So yeah. I've seen that.
Where's the best way to find you guys, contact you guys?
You can email us. Should I say my email?
You can say your phone number, your email. You can say
Email,
whatever you
phone
want.
number.
That was the invitation.
619-8713. And Steve.
Say that again.
619-458-8713 is my phone number.
Okay.
J Taormino at PB Capital, Taormino.
We'll put it up there too.
Yep.
619-787-7725, and it's S Pollett, Pollett at PB Capital.
And I would say the economy's good. You guys are lending.
We're lending.
We're lending. Well, everyone says a recession's coming.
Yeah.
They've been saying it for 3 years now. I say it's like saying it's going to rain. Eventually, you're right. So sure, there'll be a bubble, but
That's about right for the rain in San Diego.
eventually,
rain.
right.
I mean, you've been doing this 30 years. The last, I mean, for real estate, it was a depression, not a recession. And I think people are scarred from that.
Yep.
But I would say in residential loans, which probably caused a lot of it, we've been writing a lot better loans than we did before the last Great
Last cycle.
Depression.
I like the cycle.
Yeah, the last
Nice,
cycle.
nice.
I would think you guys are. If you guys think you tightened up a little bit before coming out of, not lending for 4 years, are things tightened up or changed the environment?
I'd say the last year, banks are starting to tighten up a little bit because of that. They're all worried about the bumps coming.
And we're feeling that too, like across the board, whether you're doing construction for sure, I'm seeing it. Multifamily, I'm seeing definitely commercial, some of those more vulnerable property types, office, retail. So a lot of banks are starting to either pull out of that completely or get a lot more conservative on what they're lending on.
Yep.
Yes.
So it's happening across the board.
But that's why we're here.
Yeah. And I think it's going to be more of a bump, not a a mountain.
Yeah, well,
That's just my
it would be
opinion.
bad.
I think we're all just ready to hunker down though, based on the last experience. But
I mean, I made the argument that the big dump they took in the stock market in December was the bump. Now, my bosses aren't buying it, but I've been trying to sell it. What happened? We recovered. We're done. Let's move on.
right.
They're not
Let's
buying
lend.
Or people could argue that we are kind of in the bump now, People have been saying
Some
that,
people
yeah.
say. I mean, New York real estate's down. LA's, in a
it. It's
correction.
about time. It's crazy. Right?
Yeah.
It ran for a pretty long time there. Honestly, in certain cities, I lived in San Francisco for 3 years, and it was 2007, 8, 9, and it did not feel like a recession in the city. It did
I remember
not.
visiting
Real
her,
estate
I
was
was like,
going up. People
people
were
are
making
spending.
money. It was
So it's a little bubble up there.
Its own
yeah,
bubble.
for sure.
Right,
Yeah.
right. They had an umbrella.
yeah,
Yeah.
Right.
exactly. So
So we will see. We will see what happens.
we'll see. But until then, we'll just keep plugging along. And I think banks are still lending, even if they're getting more conservative. And
There's a lot
Rates
of
are
capital out
good.
there. People do want to lend. It just it might be a little bit more tighter, but I would just say to get around the tightness, just be more prepared. Like Joe said, honestly, if you're really prepared, it's going to help you. If you're not prepared,
and
just
it's
makes
probably
it
good
harder.
business practice anyway.
Oh,
So,
100%.
Like,
But you're busy.
There's
running
that.
your
No, that's the problem.
You're
Small
running-
business,
You're
yeah.
running your business.
Yeah.
You're working 14 hours a
And
day.
you guys
honestly,
get
the
it,
best
yeah.
thing we ever did was hire a bookkeeper.
Yep.
I don't worry about it anymore.
Yep.
Yeah,
Yeah.
that's like another tip. If anybody needs a tip for their business, hire a bookkeeper.
I can't do QuickBooks right.
It's so easy. It's almost too easy because you can mess things up really,
Right.
really fast. So yeah, I just let a bookkeeper do it now.
Yes, indeed.
Cool, guys. Thanks for
Thanks so much for
listening.
coming
If you guys need to contact us, we'll put all of our information at the end of this video, including Joe and Steve's. Guys, thanks for coming in.
Thank you.
Appreciate the
Thanks,
time.
guys.
I think we all learned a little bit SBA loans today.
Cool. Thank you.
Awesome.